Welcome back to the channel. I'm Algabot, and today we're taking an educational look at an expert advisor for MetaTrader 5 called Volatility Lull Reclaim. This is a trend continuation approach, and its whole idea rests on a simple observation. A healthy trend does not run in a straight line. It pushes, then it pauses to catch its breath, and the best continuations happen when that pause is quiet. In this session, we'll explore how the strategy uses a moving average and the average true range to spot those calm pauses, and how it then looks for a single decisive candle to signal that the trend may be resuming. This is educational information only, never financial advice. So what does this expert advisor actually do? At its heart, it is a trend continuation system, meaning it does not try to catch tops and bottoms. Instead, it waits for an existing trend and then looks to join it during an orderly pause. Two familiar tools drive the whole thing. The first is a single exponential moving average, which acts as the trend's value line, the level that price keeps returning to. The second is the average true range, a standard measure of how much the market is moving, which the strategy uses to judge whether volatility has genuinely dried up. The clever part is how these are combined. Rather than reacting to every wobble, the strategy waits for a very specific three-part fingerprint. It wants a clear trend, then a quiet pullback where the bar ranges shrink and price drifts back toward the moving average value zone, and finally a strong expansion candle that closes back across the mean in the trend's direction. Only when all three line up does the strategy consider signaling an entry. Because it uses the average true range to normalize its measurements, the logic stays scale-free. That means the same rules can be applied whether the chart shows a major currency pair, an index, or a metal, and on whatever time frame you have selected. Nothing is hard-coded to a single market or period. In terms of who this style tends to suit, it leans toward traders who are studying patient, rules-based continuation entries and who care about keeping their peak-to-trough drawdown contained. The design deliberately aims for small, frequent losers and occasional larger winners. Of course, trading always involves risk, and losses are a normal part of any approach. Everything here is shared purely so you can understand how the logic is built, not as a recommendation to trade it. Let's walk through the exact logic step by step. Everything is evaluated once per completed bar, so the strategy is patient and does not act on unfinished candles. The first condition is the trend gate. The strategy measures the exponential moving average now versus its value a number of bars ago, set by the slope lookback of 8. It then divides that change by the average true range. This gives an ATR-normalized slope, a scale-free reading of how strongly the mean is rising or falling. If that slope is above positive 0.15, the strategy treats the market as an uptrend. If it is below negative 0.15, it treats it as a downtrend. If the slope sits in between, nothing happens. Next comes the lull gate. Over the pullback window of 5 bars just before the signal candle, the strategy averages each bar's high-to-low range. For a lull to be confirmed, that average range must be below 0.80 times the average true range. In plain terms, volatility must have quietly dried up. On top of that, the pullback must have returned into the value zone, meaning its extreme sits within 0.75 of an ATR of the moving average. So prices come back to value calmly, not violently. Finally, the reclaim. The most recently closed candle must be a genuine expansion candle in the trend direction. Its body must be at least 0.60 of an ATR. It must close back across the moving average, and it must close beyond the previous candle's close. For a long, that means a strong up candle closing above the mean and above the prior close. The short side is the exact mirror, a strong down candle closing below the mean and below the prior close. When all three parts align, the strategy signals an entry. For a long, the stop is placed just below the quiet pullback low, padded by 0.4 of an ATR. For a short, it sits just above the pullback high. Because the entry comes right off a calm pullback, that stop is naturally tight. If the resulting risk would exceed 3 times the ATR, the trade is skipped entirely, so no single position risks an outsized amount. The take profit is set at 2 times that risk. Once price moves 0.9 of the risk in profit, the stop is pulled to break even and then trailed by 1.5 ATR, never loosened. And only one position is held at a time. Let's read through the MQL5 code on screen, as if we were in the meta editor. At the top are the inputs. Trend period sets the exponential moving average length. Slope lookback and MinSlopeAtr are define how steep the trend must be, and ATR period drives the volatility measure. Lull bars, LullFactor, and zone AT are described the quiet pullback, while ExpandFactor sets how large the reclaim candle's body must be. Stop buffer ATR, max risk ATR, and reward risk then govern the money management. Now the long block. You can see 3 Boolean conditions. Pulled to value checks that the pullback low came back within zone AT are of the moving average. Expansion checks that the candle body is at least ExpandFactor times the ATR. And reclaim checks that the last close is above the moving average and above the previous close. When all 3 are true, the code reads the ask price, sets the stop just below the pullback low minus the buffer, and confirms the risk is within the max risk limit before calling trade.buy, with the take profit at reward risk times the risk. The short block below is the exact mirror. Pulled to value now checks the pullback high against the mean. Expansion looks at the negative body for a strong down candle, and reclaim requires the close below both the moving average and the previous close. The stop sits above the pullback high, and trade.sell places the order with the take profit the same reward to risk distance below. Same logic, opposite direction. Let's walk through this illustration candle by candle. On the left, price is climbing. The first 3 candles push higher with healthy ranges, and you can see the blue moving average, our value line, rising steadily beneath them. In the volatility panel below, the average true range is sitting up at a normal level because the market is actively moving. This is the trend gate being satisfied. The mean is sloping clearly upward, so the strategy is now watching for a quiet pause. That pause arrives with the next 3 candles. Notice how their ranges shrink, each one smaller and calmer than the last, drifting gently back down toward the value line. This is the lull. Watch the volatility panel. The average true range dips right down into the shaded lull zone, beneath the dash threshold. At the same time, the pullback's low settles close to the moving average, inside the value zone that zone ATR defines, which is 3/4 of an ATR from the mean. So we have a calm pullback that has returned to value. The market is catching its breath. Then comes the decisive candle. The 6th candle is a strong up candle whose body clears the expansion threshold, 60% of an ATR, and it closes back above the moving average and above the previous close. That completes the 3-part fingerprint, and you can see the buy entry marker appear on it. The stop is tucked just below the quiet pullback low, padded by the buffer, which keeps the risk small. From there, price advances candle by candle, and the take profit target sits at 2 times the risk, the reward to risk of 2 to 1. The following candles carry price up to that take profit marker, and the trade is complete. Along the way, once price had moved far enough in profit, the stop would have been lifted to break even and then trailed. Now watch the market roll over. The next few candles push firmly lower, and the blue value line tops out and begins to slope down. The trend gate has now flipped to a downtrend. Just as before, the strategy waits for a quiet pause. See how the 2 small candles after the drop drift calmly back up toward the falling mean, with shrinking ranges, and the volatility panel dips once again into the lull zone. The pullback high comes to rest within the value zone of the moving average. Then the mirror image signal appears. The candle marked as the sell entry is a strong down candle whose body clears the expansion threshold, closing back below the moving average and below the prior close. The sell entry marker prints, and the stop sits just above the quiet pullback high. Price then works its way down candle by candle to the take profit target, again placed at 2 times the risk below the entry. Same 3-part logic, simply flipped for a falling market. What ties both examples together is patience. The strategy ignored every candle that did not show a trend, a genuine volatility lull, and a real expansion reclaim. That selectivity is the whole point. And it is worth remembering that in live conditions the reclaim candle sometimes fails and price rolls back through the stop. That is exactly why the stop sits just past the quiet extreme, so a wrong read costs little. This walkthrough is for educational purposes only. So that's a complete tour of Volatility Lull Reclaim. We looked at how it uses a single moving average to define the trend, the average true range to detect a quiet volatility lull, and a strong expansion candle to signal a possible continuation, all with a tight structural stop, a reward to risk take profit, and a break-even trail designed to keep drawdown contained. Remember, everything here is educational information only and not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses do happen. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like us to explore next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.